Good morning. I'm Krista Gardner. I'm a partner out of the York office, and then Kevin Stouffer will be joining me for the second half of the presentation today. And he is out of the Chambersburg office, for those of you that don't know Kevin. So we're going to spend some time this morning. We focus a lot on the audit and the audit process. What we really want to dig into here is what we can be doing outside of the audit time based on our audit. So our audit results, the discussions during the audit, the communications, whether that's internal with management and the board, external with any professional service providers. So we're going to spend a little bit of time today really focusing on what to use your audit for, how to use it as a tool for your organization. First, we're going to start with communicating. So essentially between audits, what are the things to really be talking about? And this is going to be internally with staff and also with the board, and then with any of your professional service advisors as you see fit. So a couple of the examples I have on here are kind of like the big glaring, like, well, yeah, that makes sense. We definitely need to talk about them. But a couple ways to be thinking about compliance issues. So, hopefully this never happens. But if there would be any issues of fraud or irregularities or any other issues that kind of come up, unusual journal entries, even errors that can happen that might, impact the way the financial statements look or your monthly reports look, making sure that you're talking about those. Also, kind of a theme throughout this is keeping track of these items throughout the year because they're going to come up during the audit. So these are all those things that happen throughout the year and then are going to be asked about during the audit. So whether it's keeping a list of them or a folder, kind of stashing everything in there because essentially they're things that are going to need to be talked about during audit time. If there would be any new compliance requirements, so a lot of this is going to kind of stem directly from any granting or funding sources that you have that are new. ARPA is a big one that we've been talking about for, I can say years now, but any other grants that you might be getting, whether it's from the county, the state, other federal sources, making sure that everyone involved in spending that money has an understand of what's really required of that grant, how it can be spent, when it can be spent, and what procedures you have put in place in regards to spending that funding. Fund balance categories or designations. So this can go two ways. This can go designations as far as the board has elected to earmark funds. So meaning you have unrestricted funds that the board has earmarked for a specific purpose. Future capital projects, future health insurance costs, anything really that the board wants to earmark. This really comes up because we will see this year over year kind of not change. So it's a question that we're always going to ask. Hey, you set aside funds for XYZ. Have they been spent? Do you know that they're set aside? Because sometimes we come up with that like, oh, we didn't realize that we still had those funds that are set aside. So be talking about, if we have unassigned and unrestricted fund balance, should we be designating those items for a specific purpose? And on the flip side, if you have restricted funds, making sure essentially everyone is aware who needs to know essentially what is in that balance and what it's for. It's often best practice to be spending restricted funds before we're spending unrestricted funds. So if you have a stormwater project that you're doing and you've got some stormwater restricted funds on hand, you might want to be able to use those before we use, general unrestricted funds. So just making sure that everyone's aware of what's categorized and what those categories mean. That's usually the most important part. Going to more of the internal controls related to the organization. So thinking about changes. Was there a pandemic where people are working remote? Hopefully most people are back, but we know there's a good hybrid now. How does that impact your processes, your procedures? What policies have changed? What controls have changed? Have you brought on new people? Have you lost people? And essentially you've had one person assume the responsibilities of two. Right there's a big red flag where you might have lost some controls. And this is one thing where if it's not a conversation that you're having often amongst your internal staff and the board as far as what controls you have in place, this is something I really encourage you to be having a conversation on at least annually. You want to be assessing your policies, your procedures, and making sure that everything still makes sense. Similar to when we have new board members come on, we often have to change our bank signers. So the same kind of thing, thinking about what are our controls and processes related to those kind of items. Next would be anything unusual or large one-time items. Again, making sure that everyone that's going to be involved in that process really has an understanding for what it means, how it impacts the financial statements. And essentially, those that are involved and responsible, they understand the expectations related to whatever that transaction is. So again, that can be grants. So ARPA has been a big conversation. We know that that second ARPA payment maybe has arrived in the bank account for some of you, or essentially will be coming for those of you that are getting ARPA funds. Same thing with any other federal grants. When those monies are coming in, having that conversation as far as when we can expect the money. Maybe it's a reimbursement grant that we have to spend the money first and then submit our expenses for reimbursement. So just continuing to have that conversation, any large contracts, any complex accounting entries, one-time journal entries, things that come up that, again, can impact the financial information that you are looking at, that your board is looking at, or other staff are looking at. Just having that conversation as far as what they mean, why they're there. Do we expect them again? New debt falls into that as well, how that impacts your financials. As far as it changes in your finances, so this is where we're going to look at your revenue streams. We talked about grant funding. Are there any changes in your tax revenues expected? I won't point out the person, but I have one client in here who had a very large casino come into their municipality. So that changes some of your revenue streams, losses of revenue streams. And these can be unplanned and planned. You may know that we're only going to have grant funding for a certain period of time. How are we going to prepare for it not having that funding going forward? Or maybe we have an unplanned loss of revenue stream. Some of us experienced that during the pandemic, where essentially we had some revenue streams that really fell. How do we plan for that? And it's also kind of taking a look at, okay, so here's what happened during the pandemic. How do we prepare for if that would happen again? And then looking at our assets, any change in the use of our assets that we might have. Do we have any assets that potentially we are going to sell? Do we have any that we have for sale? These are all things that you want to be keeping track of because they can impact your audit. One thing I always like to say is you never have to hesitate reaching out to your auditor throughout the year. We're not just your auditor during that audit time frame. Reach out throughout the year. I always say it's a little selfish, but I'd rather take care of something when it's happening as opposed to letting it all pile up at audit time. I promise that works out for both of us, at the end as far as efficiencies. So never hesitate to reach out and even just get some feedback or a second opinion as far as how things should be handled, what documentation you need, etc. So now we're going to dig into how we get the board involved, what the board should be looking at as far as what the audit means, how we use that as a tool going forward. So there are some items that are required to be reviewed with the board from your auditor. And those items typically come in the form of a presentation, and they can be verbally in a presentation, they can be written in the form of a letter, or they can be a combination of both. In most cases, how we handle things is it's a combination of both, where we're going to do a presentation in front of the board, but then also give documentation so they have it for their records. Some of the things that we are required to speak about in those communications are going to be if there were any difficulties performing the audit. Did we receive the information we needed timely? Was it correct? Did management impose any limitations? Meaning, if we asked for something where we told it wasn't available, were there any issues in talking to people or getting supporting documentation? We are required as the auditor to communicate that to the board. Because essentially we are required to speak with those charged with governance. And in the government world, that is the board. If there were any disagreements, we want to discuss that. That would be disagreements with management. And then significant journal entries. This is an area I like to spend a lot of time on clarifying, because sometimes we'll have someone look at our list of journal entries and say, like, wow, that's a lot of journal entries. Why do we have these journal entries? Some of those can be a one-time kind of unusual item, or some of them can be routine. So it's really important to essentially identify what the difference is. Some journal entries we go in expecting that, hey, it's part of the audit process. We know there's a reliance on the auditor to essentially propose those journal entries. And others might be a one-time, unusual, kind of complex item here. What I always like to kind of have a presentation meeting with management on is, if there's any questions on journal entries, I kind of allow management to kind of step in at that point and say, hey, we've put in place some procedures that we're going to take care of journal entry 1, 2, and 3 next year. Because those are things that now we understand what needs to be entered or why it needs to be entered, how it needs to be entered. So we've already put that on our to-do list that we can get those done before the audit. The fewer amount of journal entries, the better during audit time. because that means there's less adjustment to the numbers at year end. And we've got it when we have adjustments to numbers at year end, that means throughout the year, when your board and management are making decisions based on that financial information, that's less of a change from what you were looking at when making those decisions. So that's why we like to spend some time. Journal entries are okay, they are a part of the process. But when we get to significant ones that can really impact what people are looking at on the financials, that's where we try to kind of come up with a plan to make sure that maybe those aren't lingering out there until the audit process. We'll also talk about areas for improvement. So again, this is required. There are 3 levels of internal control deficiencies. The highest level is called a material weakness. It's material to the financial statements, absolutely required to be communicated to the board. The second level, we drop down. It's not material, but still significant. So we call it a significant deficiency. And then there is a third level, which just referred to as a deficiency. If there are material weaknesses or significant deficiencies identified during the audit process, they are required to be communicated directly to the board. And really, the way we try to look at those is these are opportunities to just be discussing how, maybe improvements can be made. At the end of the day, sometimes based on your entity, we get it with the amount of staff you might have. You might just have an internal control deficiency that is just always going to be there. And the entity comes back to us and says, look, we just, we've talked to you, we understand, we just don't feel that we've got the resources to put that into play. We are okay with leaving that deficiency as is, and that's okay. But at least we're having that conversation. And again, it's going to come up annually. Usually I like to say is there's no change from last year here. This is, a significant deficiency that you've had. Here's why. And again, it's good to have that conversation, especially when you've got new board members that might come on each year. But then we also like to add in where potentially there is some other areas for improvement. So the nice thing for us is we get to work with, lots of government clients. And I might see that one government client is doing X, Y, Z. And I can say to another client, like, hey, I was just talking with someone and they implemented this, or they talked to their bank about adding this procedure. So that's kind of another thing that we get to do is really look for efficiencies or new ways to be thinking about things or doing things that we can kind of help you again, kind of achieve the goals that you need to achieve with getting the finance stuff, taken care of and out of your way. So we always try to look for those type of items. Not required, but also best practice items that we like to talk about during that audit presentation are the financial health of the organization. Now, I say financial health, that means something different to everyone. So usually what we're going to be looking at in addition to, fund balance, where fund balance is in your fund balance categories, cash flow, talking about your future needs for cash. So maybe you have a big capital project plan where you as an entity have put together, here are the cash flows that we're going to need. Maybe you're not at that point. You don't have any big capital projects, but again, looking at, okay, as far as fund balance goes, what do you have on hand to be able to cover operating expenses if something did happen like a pandemic? Taking a look at any reserves that you might have. If you have a fund balance reserve policy, always kind of updating, essentially, if you've got a reserve policy of having 6 months on hand, where did you fall? Are you above and beyond that? Are you under that? Or are you just right about at that policy level? A couple other things is we'll talk about anything that's changing, anything that's new regards to the financial statements. So that can be any new accounting pronouncements or footnote disclosures for those of you that have full financial statements. So the big one that we're going to hear about later today is leases. We will be talking a lot about this the next couple of months. So this is going to be something that's going to impact most of our governmental entities. It's going to be new accounting and new footnote disclosures that will be included. So that's just a perfect example of we want to take the time to be educating not only management, but also board members as far as what that means and what they will be seeing different in their financial statements. And then essentially as part of that board presentation, usually the board then accepts the audit. That's really a formality. In most cases, the audit's been finalized at that point. Depending on your organization, you might have it in final draft form and then you finalize it afterwards. But essentially, that's kind of the formality of ending the audit process. So then the last section that I'm going to spend some time on before Kevin comes up is management's review of the audit. So this is really using the audit communications, the results of the audit to be thinking about, how do we keep track of things that impact the audit going forward? What can we be doing to talk with our staff internally? What conversations should we be having? What's coming up in the future as far as impacting our financial statements? So first off, I want to kind of go through and define some of the items that we're constantly giving you as the auditor and go through what they are and why they're important. So the first item is the client representation letter. So this really is management's acceptance and review and approval of the audit and the financial statements themselves. So this is where it's a lot of language in it. It's very similar to the engagement letter where it's a lot of formalities, but essentially the pieces here are management is taking ownership of any proposed journal entries. There's a line in there that says we have reviewed and approved your proposed journal entries. If there are any past journal entries, meaning there were errors or items noted that weren't classified correctly that essentially, management might have decided to pass on, it's not material, it's of a low enough amount, we'll just let it go. We do have to still accumulate those items. So essentially have a list of here are all the entries that could have been done but were passed on because of the dollar amount was low enough that it wasn't required to do an entry for. So those are included, and really making sure that any other services that were provided. So although we are doing your audit, a lot of times we're assisting in preparing the financial statements. We might be assisting you in calculating depreciation or maintaining your depreciation schedules, and anything else that we might be providing to you as what's called a non-attest service or something outside the audit. Those should not only be documented in the engagement letter when we start the process, but this is kind of closing that loop on management has now said, all of this is done, and here we are going to sign off on it and accept it. That client representation letter or management letter, as we like to call it, is really the finalization of the audit. The date that's signed is typically the date that's going to be on our audit report. It's closing that full loop on here's what's done. Everyone's happy with the end product. We've got our proposed entries, etc. So then the next part, and really probably the most important part here, is review of the financial statements. So as I said, financial statements, we are typically going to assist you in preparing. In a perfect world, we would walk in the door, remotely or virtually, and you hand us the trial balance, you hand us the supporting documents for the trial balance, and you'd hand us the financial statements. That's a perfect world. Because then we would literally audit your trial balance, audit the supporting documentation, and audit your financial statements. That's what we're doing, an audit. We know that's not realistic, and in most cases, we're assisting you in preparing those financial statements, and that's okay. On our end, we have a lot of things that we have to document to essentially show that we are still independent, and you as the entity have to essentially take ownership of those statements. So you have to review and you have to approve those financial statements. I always like to remind everyone that they are your financial statements. So when it comes to the footnotes, if there's wording in there that you would prefer it to say something else, our job is to just make sure that the accounting requirements are in there, that the whatever is required based on GASB, based on GAAP, and if anything else that you have to follow, that essentially those items are in there and things are materially correct. But they are your financial statements. The only part of those financial statements that are ours as the auditor are the audit report. A lot of times that's a confusion because, again, if we're helping you prepare them and we say, hey, here's your financial statements to review, a lot of times people think like, okay, they're the auditors. They did those financial statements, but they are yours. So I always just like to put that out there. Feel free to ask questions. A lot of times wording in there will be in there since the beginning of time, since audits were required. And then somewhere along the way, someone will say, I wonder why we have this in here. And that can be you as the client or us as the auditor. And we'll kind of scratch our heads and say, yeah, that probably should have been changed. So taking a look at that information, particularly, I know some of those financial statements can be pretty long. So break it up into pieces if you need to, rather than sitting down for hours and reading through. But I really do encourage you to read through those statements and make sure that they still make sense, that the wording in there, things have changed. We try to do that as best as we can as well when we're going through and updating things, but really they are your statements. So making sure that they do make sense and any applicable changes have been made. A couple of items to spend some time on. I know I have a lot on the slide here, but really just to be thinking about you as an organization. So some of you in here might not have full financial statements. Some might just have a DCED report. So you get off the hook a little bit here because you don't have all those footnotes you have to read through. But really kind of taking a look at what your financial statements mean. If you have full GASB financial statements where you've got fund level versus full accrual level, making sure that you have a good understanding of what the differences are there. And if you're not sure, please ask questions. I get really excited when I get to spend 15, 20 minutes talking about how we go from fund level to full accrual and what those adjustments are. Sometimes I get that look of like, all right, calm down, Krista. It's not that exciting. But for us, it is. And when we get questions on the financial statements, that's really exciting because that means someone actually read the financial statements. So again, just encouraging you if there's something that like, hey, we've never really talked about this. What does it mean? And that truly goes for the board as well. And if you are finding that your board members really just do not get your financial statements, let us know. We've had opportunities to come in and do a training session on here's what your financial statements really mean. This is what this is telling you. Because at the end of the day, as a governmental entity, we have public money and we're making a lot of important decisions based on that financial information. So when we don't really understand what we're looking at, that's going to make it more difficult to make sure that our decisions are, best for the entity and are effective. Prior year, just kind of a tidbit, you can always bring up the prior year financial statements as an easy way to review what has changed. You always need to be careful because not everything is going to be the same every year. So just because something changed doesn't mean that there's an error or an issue. But that can also help us in saying, oh, I have an expectation that we had this in this year and not this in this year. And you kind of go through and you take a look at, okay, well, how did the financial statements differ? Does that expectation kind of line up with what you're seeing? With the footnotes, we as the auditor have what's called a disclosure checklist. It tells us essentially everything that's required to be included in those financial statements. This is something that can be shared with you. So if you say, and I have a client that does prepare their financial statements, and we essentially send them the disclosure checklist, they fill it out and send it back to us, and then we review it. We truly are auditing those statements. So those tools are not secrets. We're more than happy to share that disclosure checklist with you so you can kind of see, okay, what should be in there? Why is it in there? Why is it required, etc. And then just to kind of note, we will be talking about single audits later today. But if you do have a single audit, there's a whole additional piece of your financial statements then as far as having a schedule of federal awards and then also additional reports that will be included. So if anyone's going to be having a single audit for the first time due to some federal funding, we'll speak more on that later, but again, that might be a change to your financial statements. And then wrapping up my section are two letters that we give as part of the audit process. The first letter we call the management letter or the SAS 115 letter because we like to use accounting terminology like this. But as we talked about earlier is communicating internal control deficiencies. So this is the official formal letter where essentially if there are any material weaknesses or significant deficiencies or even other items, those kind of just low-level deficiencies that are ideas for improvement or changes or best practices. This is that letter that we're going to include that information. It is to management, but also gets shared with the board. Any new accounting pronouncements, we're going to have information in here regards to leases or anything else that's coming up that essentially will be changing. And this is kind of that first conversation to really say, okay, what do we need to start to put in place? What's our action plan for any of those changes coming up? How do we develop what needs to be done, or how do we remedy items that have come up in the audit? How do we make sure that if we have a deficiency this year, we're not going to have it again next year? Or again, maybe it's one of those ones that you've just always had it and everyone's okay with it. And we've kind of had that conversation on why that is the place. Again, just kind of a shout out to, please ask questions. We're here to help you during this process. Usually when we're providing some kind of deficiency or a suggestion, we also can help you kind of develop what the plan could be. What are some ideas that we've seen in other places? So it's not meant to be like, here you have a bunch of issues, figure it out. It's a conversation. It's a tool to essentially say like, okay, how can you improve? And then the second letter, this really kind of comes full circle with where I started my part of the presentation. This is the communication with those charged with governance. So this is called the SAS 114 letter. So this would be where this communication is in a formal written document. Again, it can be verbally, it can be part of a presentation, or it can be all of the above. And this is where we're really going to be talking about the logistics of the audit. So the board has that understanding, what changed? Was there any new accounting pronouncements that changed the way you recorded your transactions? What estimates go into the audit? So depreciation is an estimate. If you have an actuarial valuation, everything kind of that goes into that actuarial report is based on an estimate that your actuary has made. Any significant disclosures. So leases, again, will probably be one that we're talking about going forward. But if you've got a pension plan, if you've got debt, usually we're going to be highlighting to the board It's essentially us saying like, okay, if you're only going to spend this amount of time reviewing your financials, spend some time here. These are the notes that are really significant and impact what's going on. If there would be any disagreements with management during the audit process, any issues, and then essentially, like we said, those corrected and uncorrected misstatements or those journal entries. The list of journal entries are attached to here. And I always like to make sure that I'm, again, talking about like what journal entries were expected, what were unusual, what are one time, what are complex. But that kind of brings everything full circle. So we start with our engagement letter where we talk about all of this. And then these communications are that wrap up piece where we say, here's what we did. This is what we were supposed to do. And then these were the results.
Good morning, everyone. So what I'm going to do is kind of build on what Krista started with and go through the potential areas in which your organization can improve. We're going to go through some specific audit areas in which we typically see areas for improvement for your organization. So we're going to dive through some of those. I realize we have a wide variety of clients here or types of organizations. We have townships that might only do a DCD report. We have boroughs and townships. We have conservation districts. We have school districts. Not all these areas are going to be applicable to you, and some will have more applicability than others. But again, I think it's just some good information to have. And the other area I would recommend to look at, as Krista alluded to earlier, is to look at your journal entries. What journal entries can be corrected on an annual basis so that the auditors were not making those on your behalf on an annual basis? That's what I'd really recommend to fine tune when you're looking internally at your individual audit areas. So I have highlighted here 6 areas that we'll dive into. Capital assets, we'll spend a little bit of time on. I know everybody loves going through the capital assets and maintaining that information. So we'll have some improvements there, some items to highlight. Interfund transactions, those are your due to, due froms, and your transfers. Sometimes there's confusion there between those two, which items should be recorded where and when. Not that there's a lot of journal entries related to deferred inflows or deferred outflows. Just wanted to highlight some information there, just provide some additional information. And then finally wrap up with just some fund balance designations and classifications, as well as potential component units. So diving into the capital assets now. Again, I know everybody loves going through the capital assets, maintaining that listing and providing it to us as part of the audit. I didn't hear anybody groan on that. I was expecting a couple groans to hear from the capital assets. I realize it's not everybody's favorite part of the audit, and we can certainly appreciate that. So what we really wanted to do was fine tune or offer just some recommendations to assist with that process. And I think first and foremost, when you're looking at your capital asset additions on an annual basis, we really recommend to have a process in place to track those additions throughout the year. I think it's much easier to identify those during the year than it is until waiting until year end and then trying to accumulate that information. And same is true even if you have a township or a borough and you're DCD only. There is a schedule in the back that requires capital expenditures on an annual basis. So we really recommend to have a process to either make copies of those or make a subfolder and scan those into your computer as they come through the process. Or even if you need to include those or have those highlighted or coded to a separate account within your GL system. That way they can be found easily. And again, not waiting until the end of the year to accumulate that information. Also, just wanted to highlight one area that we do typically see some journal entries related to is related to retainage payable. So if you have large construction projects, a lot of times what happens is you're being billed over monthly installments for those as the work is completed. Retainage is basically being withheld. You don't have to pay that amount, but the work has been completed. But you still want to pick up that payable for that amount. So in other words, for that retainage payable, you don't actually have to pay that amount. So a lot of times it's harder to capture that as an addition to your capital assets, but it is work that has been completed. It's just not, you don't have to pay that amount at that particular point in time. So that'll still be recorded as a payable, recorded as an expenditure, and also a capital asset addition. So just want to make sure that you're reviewing your retainage payable for any large construction projects that are ongoing. Disposals obviously are the other offset to the capital assets. And I realize that not everybody wants to take a capital asset inventory on an annual basis, but we really just recommend to fine tune and have a process in place to ultimately determine which capital assets are no longer in use. Obviously, with additions, those are much easier to track as items are purchased. They're hitting your GL. You can look at those accounts. You can look at that detail. With disposal, something may no longer just be in use, and there's nothing that's hitting the GL for that. If you don't sell it, if you just scrap it and throw it away, it's harder to capture those. So what we really recommend to do is on a regular basis, again, whether it's annual, is to, even if you're splitting it apart by department or certain areas or certain buildings, that you're taking that annual inventory of your capital assets and remove any assets that are no longer held within the organization. The next piece of capital assets are the disclosures. As Krista mentioned earlier, the disclosures are an important piece of the financial statements, and the capital assets are obviously providing additional details over the capital asset items. The disclosures that are included here obviously include your beginning balance, your additions, deletions, and your ending balance. So the more you can reconcile that information, it helps assist us with the preparation of the financial statements. The other piece of that I think is really helpful in reconciliation process, if you have large construction projects that are ongoing, is reconciling those different projects to show here's the beginning balance, additions, deletions, ending balance amongst each of those different projects. And I think another additional disclosure that's helpful is if you have multiple projects ongoing, showing what the balance is of each of those projects at the end of the year, just to help provide additional information to the reader of the financial statements. The other piece that's a required disclosure are what's known as commitments. Obviously, if you sign a commitment or if you sign a contract the day before your fiscal year end, probably haven't incurred any expenditures related to that. But from the reader of the financial statements, it's important for them to know that you've signed a contract for that project. So a commitment just discloses how much you have a commitment for, how much you've signed that contract for, and how much has been incurred to date. The other piece of that, you also may have commitments that you're signing after year end, but before the financial statements are issued. Those can be disclosed as well as a subsequent event within the financial statement. So again, important information to the reader of the financial statements. The next category that we're going to move to are your interfund accounts. This is kind of split into two categories. There's what's known as your due to, due froms, as well as your transfers. But sometimes there's a little bit of confusion here on which entry should be recorded where. So your due to, due froms are at any given point in time, the amount if you have multiple funds, how much one fund owes another fund. I realize some of the entities here only have one fund, so this is not applicable to you. But if you do have more than one fund that's reported in your financial statements, this can have applicability. And essentially the due to, due froms, that's the balance sheet account. Those are a receivable and a payable owed between two different funds at any given point in time. So an example that we have here is if a general fund were to pay the salaries on behalf of the highway projects, and the highway aid fund is going to reimburse the general fund at a later point in time. So until that reimbursement occurs, the highway aid fund owes the general fund. So that's a due to, due from that's recorded on that activity. And that way you can get the expenses over in the highway aid fund. And then once the cash is actually paid back, you're just alleviating that due to, due from. And the activity, again, is basically eliminated the due to, due from once the amount is paid back. So just a couple items to consider here. Again, if you have a due to, due from, and for whatever reason, if it's going to be paid back in more than 1 year, that should be segregated out separately on your financial statements. So in other words, if it's a loan, if there's a capital project and it's going to be paid back over an extended period, that should be segregated out separately within your financial statements. And again, we really just recommend at least annually to go through the due to, due froms and determine what's in those balances, what can be paid back, what should be paid back. And that way you just don't have lingering due to, due froms there that are hanging out on a regular basis or more than 1 year when those amounts could be paid back. So the sooner they're paid back, once you're able to, the better, just to eliminate those accounts. Moving now to the offset or the other item that's included in your interfund activities, and those are your transfers. Again, I know the term transfer, a lot of times you may be thinking, well, we make a transfer from one bank account to another, but if they're both in your general fund, that's not considered a transfer for your financial statement purposes because those are in the same fund reported in your financial statement. So again, these are between two actual funds when you're moving money between those accounts. So that's more of the income statement impact. So you have a transfer in one fund and a transfer out of another, again, between two separate funds. There can be cash associated with this. So the second example that I have is maybe you have a surplus on an annual basis and you move that amount to the capital projects or capital reserve fund. Those are transfers from the general fund to that capital reserve or capital projects fund. You could also have non-cash transfers. An example that I'll give is, let's say the general fund purchases a piece of equipment on behalf of either the food service fund or maybe it's another fund, and that other fund is not going to pay back the general fund. So because of that, if that asset is going to be used by that other fund, you want to record that asset within that fund. So it's a transfer out of the general fund and a transfer into the other fund because that other fund is not going to pay back the general fund. So just to keep that in mind as far as the transfer is concerned, it's who's ultimately going to use that asset and recording of that transfer activity. Next, I'm just going to turn your attention now briefly to deferred inflows and deferred outflows. This is fairly new terminology as defined by GASB that defines what a deferred inflow and deferred outflow of resources are. And basically, in order to fall into these categories, it has to meet those definitions as prescribed by GASB. Before, there was something known as deferred revenue that was reported as a liability. Essentially, that no longer exists. If you do have something that meets the definition of a deferred, it's going to meet the deferred inflow or outflow category. If it doesn't meet that, you can still have a liability associated with it. It's now just going to be called unearned revenue rather than confusing it with deferred revenues and deferred inflows and deferred outflows. So the most common example that we have, there are a couple assets or items similar to assets known as deferred outflow of resources. And you can see those listed there. Again, this is more typically on the full accrual basis of accounting that you have these items. So if you're a proprietary fund, a utility operation, or the full accrual basis of accounting for your governmental activities, you could have the loss on bond refunding, a loss on lease refunding, or sales of future revenue. So again, pretty particular there, or pretty isolated comments there for the deferred outflows. But most common examples that we do have are your deferred inflow of resources, especially for your governmental funds. The most common example item that we have here are your unavailable tax revenues. So if you're a governmental fund, you can only record revenues typically if they are received within 60 days. You still receive revenues after 60 days of your year end, but you cannot recognize those as revenues. So those are considered a deferred inflow of resources. So that's more on the fund level where you have those. And you could also have other items as far as your deferred taxes are concerned, as well as other certain grants that can fall into that category. I will say at the bottom, and again, I didn't include them there in the details of outflows and inflows, but your pension and OPEB, there are a lot of deferreds associated with those as well. So in order to assist with the recording of those liabilities for your pension information, you do have deferred inflows and outflows. A lot of that is coming from your actuary for your pension and OPEB, and then we are auditing that information to ensure its accuracy. Moving now to fund balance. And again, Krista alluded to this earlier, but it's always good to review your fund balance policy. We have a lot of organizations that do have a fund balance policy. We rarely recommend to review that on a regular basis just to ensure that the information is being reported accurately and consistently with the financial statements and with the policy is in place. So a lot of times what we've seen is a policy may have been put in place when GASB 54 was issued, which is probably about 10 to 12 years ago now. And maybe certain items are occurring or there's new management that weren't in place when that policy was put into place. We really just recommend to make sure that you're complying with your policy that you did establish. Also, you want to review your restricted fund balance. So those, again, like Krista mentioned earlier, you may have grant funds or donations that come in that maybe weren't spent by year end, or maybe you have other grants that are restricted. You want to make sure that you're reconciling those items as of the end of the year. I did list December 31st here just out of habit, but obviously you can have a June 30 year end. That should say year end there, not just December 31st. But if you have a donation that comes in, maybe those funds weren't spent, those are considered restricted fund balances as of the end of the year. The next category is your committed fund balance. I realize a lot of school districts do a lot of committing of fund balance at the end of the year. Just a couple reminders here, and this is typically where a board will commit fund balances for future uses. And basically that commitment, the actual action to commit fund balance has to occur prior to year end. The amount can be determined after year end, but the actual board action to commit fund balance has to occur prior to year end. And then the last category is the assigned fund balance. And again, that's typically falls back on the policy that's in place, the fund balance policy. But typically management has the ability to assign fund balance for specific uses in the future. And just a quick reminder that if you do have a budget deficit for the next fiscal year, that is considered assigned fund balance as of the current year. So that way it's just important information to the reader to understand that. I did want to highlight briefly that the information that we just covered is fund balance. So that's for governmental funds only. So if you are an authority, if you do have proprietary funds, those designations are just for the fund balance. If you are a proprietary fund or an authority, those classifications are a little bit different. You only have net position there, and those same categories do not fall into place. So we really just recommend to review the classifications of your fund balance on a regular basis, specifically within your general fund and within all governmental funds. And those other governmental funds, again, typically have restricted or committed fund balances because they are for specific uses. The last two items that I have are just going to be ever so briefly pointed out here as far as component units are concerned. Obviously, a lot of entities could have what's known as a component unit. The GASB's kind of redefined which organization should be considered a component unit. So there is a checklist in order to assist with that determination. So if you're a borough or a township and you have a municipal authority, trying to determine whether that should be a component unit of your organization. Again, not too common. Typically with authorities that we have with townships or boroughs, sometimes with school district foundations as part of the school district audit, or if there's another organizations that may be related just to reevaluate that to determine if the component unit should be reported within your financial statements. And then the last item I just wanted to point out, Krista alluded to this already earlier as well. Obviously, items have changed over the past several years. From 2 years ago or 2.5 years ago with COVID, there's a lot more work being done remotely. When it comes to internal controls, we really just recommend to keep your internal controls in place, even if you have employees that are working remotely. You don't want to alleviate a control just because somebody is working remotely. Those internal controls are very important, and you want to make sure that you're keeping those internal controls in place, even in a remote environment setting. And again, just revisiting policies and procedures, both from an accounting and financial reporting standpoint. And that way, again, you're just having those proper segregation of duties and the proper controls on an annual basis. Well, thank you very much for your time.